Hey, what's up guys? Benjamin here, and today we've got some wild news from the stock market.
About 1,000 points for the Dow.
The Nasdaq could even decline further.
It's one of those days where everything is crashing and investors are on the edge. Let's break down what's happening and why it's a big deal. First off, the numbers are brutal. The Dow Jones took a nosedive, plummeting by 1,033 points or 2.6%. The S&P 500 dropped 3%, marking its worst day in nearly 2 years. The Nasdaq fell by 3.4%, with tech giants like Apple and Nvidia taking significant hits. Here are the key factors behind the decline, just to help you understand what's really going on. Number one, interest rates and inflation fears. The Federal Reserve's high interest rates to curb inflation are making investors nervous. The latest hiring data in the US showed slower than expected job growth. The unemployment rate jumped to 4.3% in July, the highest since October 2021. Non-farm payroll employment increased by only 114,000 jobs, which is 35% fewer than expected. Secondly, we have disappointing earnings reports. Big tech isn't helping either. Apple dropped 4.8% after Warren Buffett's Berkshire Hathaway cut its stake, and Nvidia fell 6.4% due to delays in their new AI chip production. Number three, global market reactions. It's not just the US. Japan's Nikkei 225 began all this by plunging 12.4% yesterday, its worst day since the 1987 crash, triggered by weak US economic data and Japan's decision to raise interest rates. South Korea's Kospi also tumbled 8.8%, showing that this sell-off is global. The rise in unemployment triggered the Sun Rule, a recession indicator. Over the past 3 months, the unemployment rate averaged 4.13%, rather crossing the threshold that typically signals a recession. In July, healthcare and social assistance added 64,000 jobs, which is 56% of the overall hiring. Restaurants added 26,000 jobs. However, the information sector saw job losses, showing a mixed job market. And here's where it gets even more scary. The CBOE Volatility Index, or otherwise known as VIX, known as the fear index, surged to 54 on Monday, the highest level since the 2020 pandemic crash. It's a clear sign of a heightened investor fear and anticipating market volatility. What is the real-world impact, you may ask? What does this mean for you and I? If you're an investor, it's time to review your portfolio and consider diversifying to mitigate the risk. For the average person, this can impact everything from your 401k to prices that you pay for goods and services. Despite the chaos, remember that market downturns can present long-term buying opportunities. Stocks of fundamentally strong companies often become more affordable or cheaper during sell-offs. Markets are cyclical. Today's low is tomorrow's high. But let's dive into a crucial question. Where do we go from here? What should we expect from the Fed? Will the Federal Reserve cut interest rates to calm the markets? As of now, today, August 5th, and the 6th, the Fed is holding its rates steady at a 23-year high. They've been doing this to combat inflation, but the latest economic data might just push them to change course. The rise in the unemployment to 4.3%, also disappointing job growth, is triggering these fears. So the question becomes, why might the Fed cut rates? There are a few reasons why the Federal Reserve might consider cutting rates. Number one is rising unemployment. The latest jobs report was weaker than expected. Non-farm payrolls increased by only 114,000 jobs, far below the expectations. This has caused the unemployment rate to rise to 4.3%, the highest since October 2021, as I mentioned before. This slowdown in job growth suggests that businesses are feeling the pinch of higher borrowing costs. Number two, we have the economic slowdown of the US. The US economy is showing signs of a slowing down. The Sun Rule, a recession indicator, has been triggered, as a 3-month moving average of the jobless rate is now at least 0.5 percentage point higher than its 12-month low. This rule has historically predicted every recession since 1970. And of course, the market turmoil has meant that the VIX index, or the fear index, passed to 65 on Monday, the highest level since 2020. What are the analysts saying as of Tuesday, August 6th? Analysts are divided on what the Fed will do next. Some believe that the disappointing jobs report and rising unemployment at 4.3% will force the Fed to adjust their stance on the rates. More investors are now pricing in the likelihood of a bigger 50 basis point reduction due to the sharp slowdown in job growth and growing fears, which means that now businesses will have more relief from paying high interest rates. On the other hand, some might argue that cutting rates will have a negative impact, of course. So the possible scenarios are the following. One, we get an immediate rate cut. The Fed decides to cut rates in their next meeting. It could be a big move to stabilize the markets and support economic growth. Secondly, we could have a gradual rate cut, which means that the Fed might opt for a more gradual approach, cutting rates by smaller increments over several meetings, which will give them time to assess the impact for each cut on the economy. The third option, which is the worst, is to hold steady. So the Fed might decide just to see the current economic crisis just play out and see if they want to wait for more data based on how the market adjusts or readjusts. That's it for today's update. If you found this breakdown helpful, make sure to like, subscribe, and hit that notification bell so you don't miss any future updates about finance or tech coming up. Drop a comment below and let's discuss. I'd love to hear your thoughts and predictions. Stay tuned for more updates. Until next time, keep investing wisely. Peace.